So you guys can see my screen then?
Yeah.
Okay, great. Okay, so first of all, thanks everybody for attending. I recognized last week when Pierre was giving his lecture that people were sort of in all sorts of various time zones, and so that this is very early or very late for some people. So I appreciate you guys tuning in. Also, I appreciate the the organizers of this for giving Pierre and I the chance to present what is now, I realize, like a 15 or 20-year-old research agenda that we've been working on. And so Pierre started us off very nicely last week. As I was saying before we started recording, I wasn't quite sure how much overlap there would be between the participants this week and last week. So what I've tried to do is assume some of you have seen what Pierre did last week. So I might go quickly at parts, but I also try to make it as self-contained as possible as well. So this is the second lecture. Let me just start by this. This is definitely repeating something from last week, but sometimes these things are worth repeating. So let's start with just what do we mean when we talk about over-the-counter or decentralized asset markets. And I think if you ask people, various people will have different definitions. So I try here to list some attributes of markets that we typically characterize as over-the-counter or OTC. So the first of those attributes is that you also have agents trading in small groups. So the simplest example of that is, of course, bilateral trade, where agents and investors trade in pairs. An important attribute of OTC markets is that the terms of trade, meaning the prices and the quantities, can be determined inside this group. And one example would be in a bilateral pair that they could, say, bargain over the price and the quantity they want to trade. But it's important to note that bilateral meetings with Nash bargaining, which you'll see often, is not necessary in any of these models. We can all think of markets and models that have been written to understand those markets, in which, for example, there are papers about housing markets, where you might imagine that for a particular house for sale, you have multilateral matching, so many buyers go to see a house. And you can extend the mechanism for price determination to think about all sorts of different mechanisms. So I have a paper a few years ago thinking about the role of asking prices, which is at least a common feature in the United States of the housing market, that most of these houses start with some sort of list or asking price, and then and trade can occur at that price, sometimes above it, sometimes below it. The last thing that Pierre mentioned last week as well, which again is not necessary, but is quite often the case in over-the-counter markets, is that there's some degree of opacity, and that opacity could take the shape of either sort of incomplete information ex ante about prices, or incomplete information ex post about trades and history. So in many OTC markets, there's not a particular place where you can go and see the existing prices. You have to reach out to dealers or reach out to counterparties to find out at what price they would be willing to trade. And then at the same time, in many cases, although this has changed with the introduction of different types of regulation over the years, the history of trades is also not always fully transparent. So it's helpful to contrast the types of over-the-counter markets that I'm talking about with other markets that we think are better represented, at least, by more traditional frictionless or centralized, or you might say Walrasian models of trade. So in these markets, we typically think of sort of more all-to-all trading, that anybody who wants to trade in that market can instantly and easily trade with any other participant. In these markets, the law of one price typically prevails, or at least is a good approximation. And you have transparency both ex ante and ex post. So a good example of a market that might fit more like this description is the New York Stock Exchange, where, you know, at any given time, I could pull up right now the price of a share of IBM, and I could pull up the share price of IBM on January 27th of, you know, 1997, and I could tell you the volume traded at that price, and so on and so forth. So, you know, these are two different types of market structures, and you know, this particular literature is more interested in markets that feature some of the properties described in the first three bullet points. So what kind of markets fit into this description that we've called OTC markets? Well, some very large and very important markets, it turns out. So treasuries, various types of bonds like corporate and municipal bonds, various types of derivatives, such as, you know, credit default swaps. Foreign exchange market, which is a huge market, is an OTC market. Here in the United States, the Fed funds market, which is the sort of primary vehicle through which monetary policy implementation occurs, is an over-the-counter market. And then people have also used the types of market models that Pierre and I have been working on to think about other asset classes or other classes more generally that fit well. So I mentioned housing briefly. There are also a number of nice empirical papers looking at the secondary market for capital. So, you know, things like, you know, airplanes and bulldozers, things like that. And then there are also some nice papers thinking about the market for ideas, where, you know, an entrepreneur might have an idea and he has to search and try to find, say, a venture capitalist to help him implement that idea. So these are all kind of markets that you might think that some of the tools that Pierre and I are going to, you know, he presented last week and I'll present this week, would be helpful for studying. So now why study these markets? So as I just argued, first of all, there are many large and important markets that just are over-the-counter markets. And right before we started recording, Batshibeg and I were having this conversation that I think one of the nice reasons to study these types of markets right now, especially as a grad student who, you know, might be searching for a dissertation topic, is that this just happens to be an area where both the sort of models and the data are leapfrogging each other at the moment. And I think that one of the main reasons for that is that in the last 10 or 20 years, we've just been getting better and better transaction level data for over-the-counter markets. These are markets that were traditionally extremely opaque. I think even regulators had very little idea what was going on in these markets. And starting in the early 2000s, we started collecting better and better data, and with new technologies and things, it's becoming even easier to see, you know, literally second by second trade level data between different types of agents. And so with better data, we're also writing down, you know, richer models with trying to answer, I think, ultimately one of the more important questions in this literature, which is, you know, what are the effects of various types of frictions that I mentioned on the previous slide, including, you know, spatial frictions or trading frictions, meaning it sometimes takes time to locate a counterparty, but also various types of information frictions. You know, what are the effects of these frictions on prices and allocations? The second point that I'll make is that even if you want to study market structures that don't necessarily resemble the types of models we're writing down, this is a nice starting point for understanding the emergence of different market microstructures. So I can't remember who it was, but last week there was a very nice question where somebody sort of raised their hand, which, by the way, I'm not even watching if anyone's raising their hand. So I should have said this to start, but if you want to ask a question, don't be polite, just unmute yourself and just yell at me. But somebody last week asked the question, you know, what is it about assets, where you could extend that question even further? What is it about you know, the participants in a market, the assets being traded, that make different markets end up, you know, looking quite different? So there's a beautiful introduction in the paper by Rustin Hall and the JPE in the early 2000s, and they point out, I can't remember the exact examples they used, but I think it's something like, you know, they look at different commodities, you know, pork bellies and steel rods or aluminum rods, where, you know, it's a fairly homogeneous product, And you would think that they would trade in very similar ways, and yet the market structure were very different. Well, if you want to understand why different assets end up trading in very different market microstructures, it's kind of helpful to start from first principles, to think about a world where, I have a share of IBM. What would happen if I had to go out and try and, find a buyer for my share of IBM? Try to understand what frictions would prevent that process from happening efficiently. And then that allows us to think about various types of intermediaries or institutions that have evolved in order to overcome those frictions. And those frictions might be very different in different asset classes or different markets. And that's why perhaps we see different market structures. So I think these sort of models that we're going to be working on today give you a really nice benchmark to start thinking about endogenous market microstructure, which again, since I'm talking, largely to a group of graduate students, I think this is one of the most interesting, hard, but important open questions in the literature is, why do we see different markets emerge differently? And lastly, there's a bunch of important and I would say very timely policy questions that people are grappling with, right now, that this class of models that I'm going to talk about today, that Pierre talked about last week, could be used to confront. So I think we don't have a great sense yet of whether the kind of trading frictions that we see in over-the-counter markets exacerbate or maybe even ameliorate information frictions. We also see that the distribution of assets across agents in markets where every agent can't easily trade with one another can cause different types of market disruptions. A great example of this occurred in September 2019, probably outside the Fed. Most people weren't paying attention, but the Fed funds market went a little crazy for a few days, and rates kind of went through the roof, and people didn't really understand. It looked like a market where there were plenty of reserves floating around, and people had no idea why it might suddenly seem like there was a shortage of reserves. And one of the answers, appeared to be that it wasn't just the total aggregate amount of reserves in the Fed funds market at the time, but it had to do with the distribution, who was holding which reserves and who were they able and not able to trade with. And then more broadly, and I think a lot of these questions came up after the 2008 financial crisis, because, in that crisis and quite honestly in the March 2020 crisis in certain financial markets, a lot of them originated in over-the-counter markets. So in 2008, many of you know that the crisis originated in the mortgage-backed security market. In March of 2020, we saw disruptions in the treasury market and the corporate bond market. These are OTC markets, and regulators are grappling with questions about whether these markets should be forced onto more centralized exchanges. But we don't really understand, I would say, the welfare effects of making these markets more competitive, more centralized, more transparent. So there are a lot of really interesting and important questions. And so, that's my 5-minute spiel to try to get people interested.
Excuse me, Ben.
In this topic, yeah.
Yeah. My name is Maria. I'm from Simon Fraser University. Well, you brought up the 2019, September 2019 event.
Yeah.
I didn't get when agents were holding to their money and not lending it out at this high rate. Was it because of regulations, or because you said it depends on the distribution and who has the money?
Yeah.
But I think if they have the opportunity at that high rate, they should lend it out. But it seemed like even those who had the opportunity to lend out didn't, right?
Yeah. So let me say, I don't have the answer to that question. I'm not sure if anybody has a perfect answer to that question, and I don't want to sort of make one up. One possible answer, though, I guess, and that's what I was referring to, is that it's possible that some of the people who did have excess reserves and who you'd think would be a natural lender were not connected to or didn't have existing relationships with people who wanted to borrow at that particular time. Now, people forget that for some of these financial institutions to lend, that to establish a new relationship is not an instantaneous thing, right? So one answer, and I'm not saying necessarily this is the answer, because I think there are a lot of other things going on there, is that the reserves being held by certain institutions, could not be lent instantaneously to some of the people who were wanting to borrow at that particular rate. But let me try to come back to some of those questions within the context of some models that we're going to write down, to see if maybe we can kind of frame some of these questions more formally within the context of a model. But does that answer your question at least a little bit for now?
Yes, thank you. I had, I didn't know that there might be actually matching issues. Because I was reading Fed's pages about it, and they were mostly talking about reluctance. I was wondering, why were they reluctant?
Yeah, and then there's also, I mean, we can really get into the weeds here, because there's also all sorts of kind of institutional details that matter in some of these things. Like some of my own work on understanding kind of lending in the Fed funds market ultimately came down to understanding that, if you lend through this facility, it clears at 11 a.m., whereas this one clears at 8 a.m. And so some people prefer to have money early in the morning than late in the afternoon. You know what I mean? So sometimes it's these little institutional details. Sometimes there are, sort of regulatory issues that make people. So some of these things are really in the weeds about, very specific institutional details. But let's push on a little bit, and then hopefully at the end, I left a lot of time to kind of come back. Maybe we could talk about more specific questions about some of these things.
Sure,
so,
thank you.
No problem. So Pierre pointed this out, and it's important to do so, that there's a variety of different approaches you could take to thinking about these over-the-counter or decentralized or fragmented markets. So one completely different class of models, although the two have been kind of connected in some papers, would be sort of going down the network route. I think about network theoretic models. I was happy to see that the organizers have Marzena Rustek from Wisconsin coming to give a talk in a few weeks, and my guess is that she's going to be touching on some of those models. Pierre and I and many others on this call have been pursuing a more search theoretic approach to understanding over-the-counter markets. And this literature has a long history, but was sort of, I guess, jump-started maybe in the early 2000s by these influential papers by Duffy, Garliano, and Peterson, and since then have continued to grow and be extended in many different directions. But the way Pierre and I chose to sort of set up these two lectures is to think about sort of two broad class or two benchmark models. And a fundamental that runs through both models is thinking about an environment where you have this set of investors that can hold, and in the simplest version of the model, say 0 or 1 unit of an asset. Think of it as like a Lucas tree. And hardwired into this model is that these investors periodically get shocks that make them value the asset, or you could think about value the fruit, the dividends of the tree differently. And Pierre actually talked at length last week about various ways to microfound this preference structure. You could think about, investors with different portfolios who have sort of different, risk exposures to one particular asset. You could think about investors with different risk preferences, time discount factors, beliefs, and so on and so forth. But in the simplest version of the model, we just hardwire it into the preferences and say, they're investors, they're out there, some own an asset, some don't, and their flow utility from holding such an asset varies across investors and varies over time. And then within this basic structure, we've considered kind of two benchmark market structures. And the one that Pierre went through last week is what he called a semi-centralized market. And I've tried to kind of draw this model in one simple picture. Whenever I teach graduate students, I always tell them that if you can draw a model, you should. Many of the papers that I remember the best, it's because I walk out of a seminar with one key picture or one key figure or one key graph in my head. And so I've tried to do that here. And what I've tried to do here is draw the simplest version of what I think of as a semi-centralized market. So the paper that you would associate with Duffy, Garliano, and Peterson's 2005 Econometrica paper. So here's an environment where we have customers who can have one of two types of preferences. So they can have a high flow utility from holding the asset or a low flow utility from holding the asset. And so blue in this picture denotes having high utility, red for low. And then they can own 0 or 1 unit of the asset. So a full circle you can think of as an investor who owns a unit of the asset, and an empty circle is one where they don't. And so the model that Pierre set up for you guys last week was essentially a model where there were customers who kind of either owned or didn't own an asset, and they were either in the high or the low state, and periodically they went back and forth from liking assets to not liking assets. And so if you look at this picture in front of you, what you'll see is that there are two empty blue circles. Those are investors or customers who have a high marginal utility from owning an asset, but they don't own one. And there are some full red circles, which mean there are guys who have a low flow utility from holding the asset, but they own it. So there are gains from trade from these guys. And the way that the semi-centralized market is set up is that customers periodically, so with some Poisson arrival rate, meet a dealer. And the dealer, you could think of, meets the customer at the front of the store, and they can bargain over the price. But what's magical and what makes this model very tractable is when the dealer goes out the back door of the store, they have access to this frictionless interdealer market where they can instantaneously trade with other dealers. Okay, so basically in that model, what dealers are is they're gatekeepers to a centralized market. And since there's value to the customers for the immediacy, the gains from trade, and there's bargaining, the dealers take a piece of those rents. Okay, and so this semi-centralized market is a beautiful model, understanding how two frictions basically search the fact that customers only periodically meet with dealers, and bargaining, the fact that the dealers are able to expropriate some of those rents, create bid-ask spreads. Right, so bid-ask spreads have been a reality for a long time. There are various theories of where bid-ask spreads come from. There are inventory cost models from the 80s. There are information-based models like Gloston and Milgram and Kyle and others. And so you could think of this Duffy, Garliano, Peterson paper as essentially a theory of bid-ask spreads based on search and bargaining frictions. But this competitive, frictionless interdealer market kept things very tractable. And so that's kind of like a very short summary of what happened last week. So this week, we're going to do what I'm going to call a pure decentralized market. And in this model, and again, I've drawn the sort of simplest version here, but in this model, there's no distinction. There are no ex-ante different customers and dealers. We're just thinking of they're investors. And again, these investors can have different preferences. Here I've just drawn two, but we're actually going to model them with a much richer preference structure, and they can own assets or not own assets. And so the model, again, is going to be a search model where these different investors periodically randomly match with one another, and they can bargain over the gains from trade. So in some ways, it's really one of the simplest kind of economic models you could think of, but we're going to show that you get a lot of bang for your buck in solving. Okay. So that's where we're going today. Before I jump into the model, are there any questions at this stage? Great. So just a slightly more formal description of the environment. So these are, we solve these models in continuous time. They're infinite horizon models. We're going to normalize some measure of risk neutral investors to 1. We're going to assume that these investors discount the future at some rate R. In the background, in a lot of these models, there's always an assumption that there's this numeraire good that can be produced and consumed by all investors. Of course, this is just kind of a cheap way to sidestep, really modeling the media of exchange that people use to actually pay for the assets they buy. So this is kind of a cheap way to just assume that there's transferable utility between investors when they determine the terms of trade. Now, of course, some great work has been done by Shenjing, by Lucas, by others, thinking hard about how people actually pay for assets and the interaction between medium of exchange and asset prices themselves. Okay, but in the sort of simplest model here, we're just going to think about, you know, if me and you agree to trade, I can kind of, with some linear disutility, produce a numeraire good, and you consume that good with some linear utility. We're going to fix some measure S of indivisible assets. So you could think of these as claims to Lucas trees. And again, in the simplest version of this model, we're going to assume that investors hold either 0 or 1 unit of the asset. So again, these investors, when you own a unit of asset, you get some flow utility, which we're going to denote by delta. And at some Poisson arrival rate gamma, you're going to draw a new delta from some distribution that we're going to call f of delta. Okay. Now, again, I'm going to try to write down the simplest version of this model. You can add some persistence to these shocks, so you can make, you know, delta prime a function of your previous delta. And so long as that Markov process has certain properties, everything I'm going to say today is going to go through, but we're going to try to just kind of pin down the simplest version of this model. In that spirit, I'm also going to assume that the initial distribution of types at time 0 is also f of delta. So if you think about it, if the initial distribution of types is f of delta, if a random sample of guys at every point in time are getting a new delta, but it's also drawn from f of delta, then what's nice about that special case is that at every point in time, the distribution of types is f of delta. Now, in a paper of Pierre Olivier, myself, and Julien Huganier, who's coming out in TE soon, you know, we also are very explicit about solving for the case when the initial distribution is different than this f of delta. So why might that be interesting? Well, you know, you might want to think about an environment where you're in one steady state and boom, there's some liquidity shock. Maybe a lot of people suddenly have a low marginal utility from holding an asset, and therefore you might want to kind of study the transition path after an aggregate liquidity shock back to some new steady state. So all of this analysis can be accommodated for that as well. But for here, we're going to kind of just look at a constant distribution of types. And the last piece of the puzzle here is that investors are going to be randomly matched with each other at some, again, Poisson arrival rate lambda. And once they do, they bargain over the price. We're going to assume that the investor with some asset holdings Q, which is either 0 or 1, has bargaining theta Q, bargaining power theta Q, excuse me. Of course, theta 0 plus theta 1 has to add up to 1. And we're going to denote the price between an asset owner, so somebody has 1 unit of the asset and whose current valuation or flow value of owning an asset is delta. When they meet a non-owner who has some valuation delta prime, if they agree to trade, we're going to denote that price by P of delta, delta prime. And I guarantee I will mix up the order of those many times. So please feel free to correct me. So this is essentially the entire description of the model in one slide. So this is a good time to take a quick pause and just ask if there are any questions about the physical environment.
Hi, Ben. I'm Gabriela from Barcelona. So are agents endowed with the asset? Some agents are endowed with the asset or not?
Yeah, so they have some initial condition, and I'll show you some graphs where we play around with that as well. But yeah, just think about at some initial time t, a fraction s of the agents are endowed with 1 unit of the asset, and 1 minus s but do not have the asset. Good question.
Thanks.
Sorry. Any other questions here about the environment? Great. So I mentioned before that, you know, in some ways, this picture looks more complicated than this picture. But this model is actually simpler to solve than this model. And the reason is that there's an important state variable when you're solving a model of these pure decentralized markets, and it's an infinite dimensional variable. It's the joint distribution of asset holdings and types. Okay, and you know, one of the tricks that we show in the paper is that a lot of time people would think of measuring these things in terms of densities, in terms of sort of PDFs, but it's actually easier, more tractable if we look at these distributions in terms of sort of cumulative measures. Okay, almost it's CDFs, but I have to be careful because these things don't add up to, don't integrate up to one. So this capital phi QT of delta, which is a mouthful. So this is the cumulative measure of investors who hold, you know, say 0 or 1 unit of the asset, who have a type, current utility type or preference type delta prime less than or equal to delta at some time t. Okay, and these are the things that matter. And the reason that they didn't matter in the semi-centralized market is because if you're an investor, all you do is trade with dealers, and dealers are the same, they trade with you at the same price. So you don't actually care in that model as much about the aggregate distribution. You would understand there's going to be some arrival rate of trading opportunities, and when that happens, you're going to trade at a particular price. But in pure decentralized markets, you have to think about all the trading partners that you might meet. And in each one of those meetings, because the Nash bargaining solution is going to depend on both your type and their type, you have to know the joint distribution across all agents. And that's why these are slightly more complicated to solve, but I'm going to show you it still remains extremely tractable. Okay, so these are going to be two very, very important objects. It's phi 0 and phi 1. Of course, they have to satisfy some basic accounting identities. So I told you that at each point in time, the total CDF of agents whose type is less than delta is f of delta. That's an exogenous distribution. So these two endogenous distributions have to add up to f of delta because everybody's holding either 0 or 1 unit of the asset. And then also keep in mind, again, I don't think I actually said this, but we're going to assume that the support of the distribution of delta will normalize to 0, 1. So if you look at the total measure of agents who don't own an asset, that has to be equal to 1 minus S. And if market clearing requires that if you look at the total measure of agents who own an asset, it has to equal the exogenously specified measure of assets. S, okay? So any questions about these joint distributions? Great. So Pierre actually spent a lot of time last week on the frictionless benchmark. I'm going to do it in 1 minute because I'm going a little bit slower than I anticipated. But if there's any confusion here, I highly recommend go back and increase Pierre's YouTube count to see, because he went through this at great length. But keep in mind, we had a sort of frictionless benchmark. We thought about an environment where agents had these preferences that changed over time, but where they existed in an environment where they had always instant access to a competitive centralized market. Pierre showed you that there was this important concept in this frictionless environment, which we're all very familiar with from, you know, first year micro, I guess, which is thinking about the marginal utility type, which we call delta star. And if you want to think about delta star at a very intuitive level, just think about lining up every agent according to their preference type delta. You have S assets to hand out. Give the first, you know, share of asset to the guy with the highest delta, then the next, and the guy, you know, the one when you run out of asset, that's your delta star. Okay, and so Pierre used this picture here to represent the allocation, where on the left, which is sort of like a two-story picture, is just the exogenous distribution of utility types. And on the right, up top, we have the distribution of owners. And on the bottom in green, we have the distribution of non-owners. So basically what this is saying is just what I was trying to mention before. All the non-owners are the utility types here who don't own the asset. And then all the owners start with that marginal type, and each one of them owns an asset. And Pierre told you that the price at all times in this dynamic but frictionless environment, the price was always priced by the marginal type, which is delta star, appropriately discounted. Okay, so that frictionless benchmark is going to turn out to be helpful. But now let's, you know, since I've gone through that very, very quickly, let's go and now let's solve the model that I described with search frictions. Okay. And we're gonna do this derivation in 2 steps. Everything today I'm gonna do is the steady state. I'll show you a little bit of non-stationary stuff towards the end, and you can ask me questions if you find it interesting. Okay, so the first thing that we're gonna do is we're gonna take as given these 2 key objects that I mentioned before, these joint distributions, phi0 and phi1. So take those as given, and we're gonna derive these objects that we call reservation values. And again, I'll remind you from last week, the reservation value is the difference between what we call V1 of delta, V0 of delta. So V1 of delta is the value function, the expected discounted value of holding 1 unit of the asset when your current utility type is delta. And V0 of delta is the expected discounted value of holding no assets right now when your current utility type is delta. And we basically are not going to talk about V1 and V0 separately the rest of the time. Everything we can do, we're going to base off of this reservation value, which is the difference between the 2. So of course, when we teach undergrad reservation value, that's usually, someone's willingness to pay. So, the name is not by accident. Their willingness to pay is exactly the difference between their expected value when they own the asset versus their expected value when they don't own the asset. Okay, so this reservation value is going to be extremely important. The price, we can solve for immediately. It solves this very simple Nash bargaining problem where the person who owns the asset, their payoffs from trading would be P, plus their continuation value would be V0. They would no longer own the asset. Whereas their outside option is just continuing to own the asset, which is V1. So this is the surplus for the owner of the asset, and likewise, this is the surplus for the non-owner. You take first order conditions, you solve, and you see immediately what I was just referring to, is the price itself can be expressed exclusively in terms of the reservation value of the two parties. And if the person who doesn't own the asset has all the bargaining power, they're going to pay a low price. They're going to pay the reservation value of the guy who owns the asset. And if the owner has it, he'll push the price higher to the reservation value of the non-owner. Okay, so this is this reservation value is a key object, and what I'm going to show you in a slide or two is that we are going to prove at a very elementary level that these reservation values are strictly monotone in the delta. Okay. So let me just kind of emphasize that result for a second. Because what it tells you is it tells you that there are gains from trade if and only if the non-owner currently has a higher delta than the owner. Okay, so for those of you who've studied some search models before or even other related models, a lot of times what you do is you will conjecture a trading rule, and then go look for an equilibrium that satisfies that property, and then kind of double check your original conjecture. So that's not what we're doing here. What we're doing here is establishing from a primitive level that every equilibrium is going to have reservation values that are strictly increasing in type. And what that means is, again, that the trading rule is trivial. If an owner of type delta meets a non-owner of type delta prime, they trade if and only if delta prime is greater than delta. And that's going to be the key to making this model extremely tractable. For those of you who have studied labor economics, there's something similar in these job ladder models like Burdett-Mortensen and Postel-Bonnet-Robin, where you sort of show from the beginning that a worker will always transition from a lower productivity firm to a higher productivity firm. And that allows you to sort of bifurcate the problem. You could solve for the distribution separately and then go back and solve for value functions, wages, and stuff like that. The same is going to be true here. So we're going to solve for these reservation values. We're going to prove this essential property. And then given that trading rule, we're going to be able to go ahead and derive these distributions, phi 0 and phi 1. And what's nice is then you put them together and you have the equilibrium, but also since it's not a conjecture and confirm kind of game, it's you've already established exactly the trading rule. In any equilibrium, uniqueness comes almost for free. Okay, so we'll proceed now. We'll start with step 1, and then we'll do step 2. Any questions about this basic structure of characterizing the equilibrium? Awesome. So again, I'm going to lean heavily on Pierre because he did a fantastic job last week of sort of deriving these HJB equations. So I'm going to jump into them a little bit, perhaps more quickly so that we can move along. Hopefully, though, these are quite intuitive. So what I've written here, I've already done a little bit of simplification, but not too much, is what is the HJB, the flow value from owning one unit of the asset when your current utility type is some arbitrary delta. Okay, well, you own the asset, so you get some flow utility delta. With arrival rate gamma, you're going to switch types. Again, I have these as IID shocks right now, so your new type delta prime will be a random draw from this distribution f of delta. And then a trading opportunity might arrive at rate lambda, and you will trade if and only if there are gains from trade. So either you won't trade, right? So there's zero there. But if there are gains from trade, you will trade. When are there gains from trade? Exactly when, you know, the transition from being, you used to be an owner, and now you're a non-owner, but you were given some price P to give up your asset. If that is positive, then of course you would trade. Now, you have to think about what's the price at which I'm going to trade. And I alluded to this earlier. Well, I have to think about the distribution of those in the economy who do not own the asset, which is precisely that d phi 0 of delta here. Okay. So in other words, the flow value of owning a unit of the asset is I enjoy the fruit of my Lucas tree until one of two things happens. Either I change type or I get the opportunity to trade, in which case I trade at some price that depends on my type and the type of a randomly drawn non-owner from the economy. The flow value for someone who owns 0 units of the asset, who we call a non-owner, is very similar. The only difference, of course, being is that you don't get delta because you don't own the asset, but you could switch types. And if you meet somebody, you may pay some price to become an owner and transition out of being a non-owner. And now the relevant distribution of delta primes that you're thinking about when you're thinking about the price at which you might want to buy the asset or might need to buy the asset comes from the distribution of owners in the economy. You take the difference between the first equation and the second, you plug in that P from here, and you have a nice HJB equation for this reservation value. And as I said, from this point forward, we can dispose of V1 and V0 as separate objects and just concentrate on this reservation value, okay? And this thing has what I think of as an interesting form. So now this is the flow value of essentially how much this asset is worth to you, what you're willing to pay. Well, what's it worth? Well, again, you get some flow value from owning it. Once in a while, your reservation value is going to change because of a preference shock. And then there are actually 2 option values that enter into this reservation value. So the first one is this. I understand that if I acquire the asset right now, in the future, I'm going to be able to sell that asset, okay? And when I sell that asset, as a seller, remember my bargaining power when I own one unit of the asset is theta 1, I will extract a fraction theta 1 of the surplus between my reservation value, delta V, and the reservation value of whoever it is that I meet, whose delta is higher than my own. So this is a natural thing. Whenever we buy, say, a stock, a lot of the value of owning that stock, sure, it might be the dividends, but we also recognize that at a later date, we might sell that stock to somebody else who values it even more, in which case we'll capture the option value of selling the asset. But you'll notice here that there's this negative term at the end, and this is a little bit different. I'll compare this to the expression last week in the semi-centralized market. Remember that we've imposed on this model the requirement that agents own either 0 or 1 unit of the asset. So if I acquire 1 unit of the asset right now, I'm giving up the option value of buying it from somebody at perhaps a better price if I were to meet somebody 5 minutes from now. And so this last term enters with a negative sign. I understand that by acquiring the asset right now, I forego the option to continue searching and maybe even find a better price. So the option value to sell the asset tends to increase my reservation value, right? The fact that I can resell this asset makes me like it even more. But the fact that I could have waited and gotten a better price decreases my reservation value, makes me more wary of buying right now. So let me see, how am I doing on time? So I'll come back to this. I'll do this actually very quickly. So one nice thing about these models is that you can actually solve for these reservation values in closed form, and we do that in our TE paper. And we do it using this idea of this local surplus, which we call sigma, or the marginal surplus, which is essentially, if this reservation value is differentiable, you could think about it as the derivative of your reservation value at a particular delta. And we show that it takes on this form here. So what is this thing here? So this is basically like an effective discount rate. Okay, so here's the thought experiment that I want you to think about when I think about taking the derivative of the reservation value at a particular point, delta. So how much extra expected discounted value would I create from passing the asset from an investor whose type is delta to an investor whose type is delta plus epsilon, a little bit more, right? Well, I would generate a little bit more surplus until one of a few things happens, right? So on the one hand, you could think of R, right? R is like the discount factor is like in these models is equivalent to thinking about like the probability that the world ends. So it could be that the world ends. That happens with probability R. It could be that a new shock arrives, in which case the guy with preference type delta and the type guy with price delta plus epsilon, that difference evaporates because both of them are going to draw a new delta. And it could be that these guys traded or missed an opportunity to trade, and those are these sort of effective discount rates here, adjusted for the bargaining power. So if I gave the asset to a guy with a little bit higher delta, when he went to sell, which happens at rate lambda times this thing here, right? This is the probability that he met somebody who wanted to buy the asset for him, he would have gotten a little bit more of the surplus. Okay, so anyway, I don't know if that made any sense, but this is like an effective discount rate which measures the slope of the reservation value at each delta. But then you could use the fundamental theorem of calculus, I guess it is, and you could actually solve for a closed form expression, because look, at this point, everything in this equation right here, we're taking as exogenous right now. So this equation right here is actually just basically like a closed form solution for this reservation value as a function of a bunch of things that we're taking as exogenous. We're going to solve for these distributions in a second. Everything else is a fundamental. Okay, so that was a short detour there. Okay, so the last thing, so we characterize these reservation values here in a pure decentralized market. I just want to compare these with what you saw last week. So the one in red is the reservation value that Pierre derived last week in a semi-centralized market. The one in blue is the one that I just derived. So the first two lines are identical. Of course, in a semi-centralized market, you do have the upside of acquiring an asset is you might be able to sell it to a dealer at a different date, but you don't have this last term here because there is no price dispersion in that model, right? So there's no option value of not buying now. Or sorry, there's no option value of foregone option value of buying now that you won't be able to buy later because the price now and the price later are all the same. Okay, but you also see why why this pure decentralized market is a little bit more harder to solve in principle, because here you have these distributions floating around, these infinite dimensional objects that are part of the reservation values. So that's solving half of the model. Again, let me pause and just see if there are any questions, because I said a lot of words there. Okay, so now we have reservation values, but we haven't figured out these distributions yet. So let's go to these distributions. Okay, so given the, as I mentioned before, given the monotonicity of these reservation values, the trading rules are trivial. The asset passes from a guy who owns it to an investor who doesn't own it if the delta goes up. Okay, so we write down these what I always call it inflow-outflow equations. I guess they're forward Kolmogorov equations. So this is the change in the measure of investors who own one unit of the asset whose current type is less than some delta. Okay, so how can that measure change? Well, first of all, and so here, again, I try to use pictures wherever I can. So think about this, the higher of these two parallel lines, think about this as the owners of the asset as I vary delta from 0 to 1, and think about this lower line here as the owner of the measure of non-owners as delta goes from 0 to 1, and pick an arbitrary delta here. And we are essentially looking at this set along the line, this parallel, upper parallel line here. Oh, I didn't want to do that, sorry. Below delta, okay? So how can people exit this set here? Well, so of course they could get a preference shock. So you have a measure phi1 of delta of investors in this set right here. At rate gamma, they get a preference shock. And with probability 1 minus f of delta, that preference shock takes them onto the right side of this arbitrarily chosen delta. So that's the outflow from this set that comes from switching types of preference shocks. Now, there are also inflow from preference shocks. You have this set up here of S minus phi1, that's the measure of these guys. A fraction gamma of them get a preference shock. And with probability f of delta, they transition into this state here, okay? So there's inflow and outflow coming from preference shocks. Now there's also potentially inflows and outflows coming from trades, but only one of them shows up here, and I'll explain why. So first of all, you can leave this set of owners whose type is less than delta if you sell the asset, right? Somebody comes along and buys it, you transition to becoming a non-owner whose type is less than delta. But we don't see this, what you might expect is like a fourth term of an inflow into this set from trade. And the reason for that is very simple, that if anybody whose type is less than delta buys the asset, sorry, I think these buy and sell should be in different spots. If anyone buys the asset, they enter this set, but they necessarily bought the asset from someone whose delta is less than their own. So that person would actually, those two would offset each other. So you always have zero net inflow from those types of trades, okay? So basically what we have here, we set this equal to 0 because we're looking for a steady state equilibrium. And we go back to this aggregate consistency requirement that the sum of phi0 and phi1 has to equal f of delta at every instant. You plug this in, and you get this very simple ordinary differential equation. It's called a Riccati equation, and it has a unique solution. That solution is written out right here, and the only thing I've highlighted here in red is that the solution to this Riccati equation depends everywhere on the ratio of gamma, which is the arrival rate of preference shocks, to lambda, which is the arrival rate of trading opportunities. So what matters is not just how quickly you meet people, but how quickly you meet other people to trade relative to how often you yourself change types. Okay, so we've basically done all the hard work now. Okay. So what's an equilibrium? An equilibrium are prices that solve the Nash bargaining solution, easy. Reservation values that solve the HJB equation. I actually showed you have a closed form expression for that, and a distribution that solves this equation right here. Okay. Since we proved that these properties are true in every equilibrium, and we know there's a unique distribution, and we know there's a unique reservation value, the equilibrium is unique. So what we've got here is you started with a fairly rich environment where, you know, agents are in a decentralized market. They have arbitrary heterogeneity over their preferences for an asset. And yet you can solve in closed form, it turns out, not just in the steady state, but also out of steady state. I'll show you a little bit of that in a second. For the distribution of assets, for the reservation values, and from there you can back out all the prices or everything else you want. Questions? Awesome. So I mentioned that, you know, I'm not going to go through it all, but you can also derive all the same closed form solutions if you want to think about out of steady state, which again is nice if you want to think about, you know, we were talking earlier about certain shocks, you know, what happened on, I don't know, March 8th, 2020, when we realized that COVID was going to kill the world for 2 years. Well, you know, a lot of people suddenly wanted to sell. You can model that as a sudden, you know, increase in the fraction of agents who have a low delta. This graph here plots the convergence of these distributions of non-owners and owners to the new steady state. So somebody asked very early on about initial conditions. So this dotted black line here, or I guess it's dot dash black line, is if we had a random allocation at time 0 across, and then we look at, you know, different points in time watching this distribution converge to the steady state. And what you see is that the distribution of owners is slowly converging to higher and higher deltas. Remember, these are sort of like cumulative CDFs almost. So you're pushing the distribution of owners towards higher deltas, while the distribution of non-owners is getting pushed to lower deltas, which is exactly kind of what you would expect as the allocation moves, you know, towards its steady state. And again, we have this paper coming out in TE. Pierre, Julien, and I are also working on a book for the Princeton University Press, so all of this will be in there as well. Okay, so let's just take stock of where we are. We wrote down a model of pure decentralized trade with arbitrary heterogeneity preferences. I showed you closed form solutions in steady state. I waved my hands and told you that if you want to go read a paper, there's also closed form solutions at a steady state. What's nice about this is, you know, the original two-type case that Duffy, Garliano, and Peterson put in RFS in 2007, this is essentially no simpler than the one with arbitrary heterogeneity. So for the rest of the lecture,
can I ask a question? So
sure.
The fact that you can solve things closed form is pretty amazing. I'm curious how general that result is. Is it like some, you know, result specific to your particular heterogeneity you have, or do you know, like, do you have any idea like how?
Great
For example,
question.
in my model, I have 2 types, you know, like high and low type, but clients or investors differ by the shock, the intensity of the shock with which they'll, you know, revert from high to low.
Right. So it's a great question, and the answer is that, you know, for things to be as simple as they are here, and we could talk that later about, you know, as they get more complicated, but so long as you're making assumptions that preserve the monotonicity of the reservation value, okay. So for example, suppose we allowed your type to be Markov, but it was persistence in the sense that if you had a high current valuation, you are more likely to have a high valuation in the future. Then that monotonicity is preserved. And you could do other things like that. Where you run into trouble is if you lose that monotonicity, then you can't split the problem into sort of 2 sections, right? Where you can't know the trading rule without knowing the distributions, and you can't know the distributions without knowing the trading rule, then you have a more complicated fixed point problem. But you can do quite a bit with this, and then you get into, you know, I think those, you know, when it gets more complicated, it often also gets more interesting at the same time. So it looks like I have about a half an hour left. So let me do two things. Let me just kind of walk you through a little bit about how this benchmark, this kind of the simplest version of this model works, just to show you some of the things that you can sort of squeeze out of this simple model. And then let me take a few minutes at the end to talk about various extensions and applications that people have done to try and confront issues, data, so on and so forth. And I should say up front that it's going to be a very incomplete list of extensions applications, and I'm invariably going to leave people off and make some enemies. But I don't mean it to be exhaustive so much as I mean it to kind of just pique your interest in this set of models. Okay, so how does this benchmark model work? So I showed you some equations, but I want to kind of give you a better sense of, you know, how it all works, how it feels. So I have I guess it's a sort of nod to the Beatles here, but let's think about just a day in the life of an asset. So what happens to an asset as it gets traded over time? So in this graph here, I guess it's a little hard to read. I have, as opposed to that cumulative measure, I have more like the density. So this is the density of non-owners in a steady state. Okay, where on the x-axis is the delta, the utility type, and on the y-axis is this density. So as I mentioned before, in a steady state over time, when you reach that steady state, you know, most of the people who don't own the asset are going to be low delta guys because they don't value the asset much. So they probably at some point, if they did own it, got rid of it. And there are going to be very few people with very high valuations who don't own the asset because in a steady state equilibrium, they probably would have found the asset and bought it. Now, of course, there are some people with high delta right now who just haven't, you know, maybe they just got a preference shock, or maybe they just have been unlucky and haven't found somebody to trade. But in general, you're going to have more non-owners with high delta and fewer high owners. No, more non-owners with low delta and fewer high owners with a high delta. So let's think about for a second what the experience of an investor who owns an asset but has a very low delta, call it delta 1. Okay, so first of all, this investor, almost any non-owner that he meets is going to have a higher delta. So with very high probability, whenever he meets a non-owner, he'll sell the asset. So that means he'll sell the asset pretty quickly in general. Maybe he'll sell it to an investor with type delta 2. Now, delta 2 is going to hold the asset for a while, and she's going to be meeting people, but a lot of the people who don't own an asset that she meets are going to actually have a lower delta than her because she's kind of in the middle there. But eventually she'll meet somebody who has an even higher type, say delta 3, but it's going to be slower. So all this is to say that the asset typically will be passed through what we call like a chain of inframarginal trades. The first trade on average is going to happen the most quickly because the most non-owners will be willing to make that trade. And as it passes up this sort of delta chain, the trades are going to get slower and slower, but the prices are going to be rising because remember I said the reservation values are increasing in delta. So each one of these delta 1, delta 2, delta 3, these people have higher and higher reservation values. They're going to bargain better and better prices. Okay. An investor's type, their delta, is going to affect not only how quickly they trade, but also with whom they're going to trade and the price at which they're going to trade. What's interesting is that this is definitely not the case in a centralized market where we all trade at the same price at the same speed. But it also wasn't the case in the semi-centralized market we studied last week, where any non-owner who encountered a dealer, which they all did at the same rate, and was willing to sell, would sell at the same price, or buy at the same price, I guess, if I'm talking about non-owners. Okay. So these have important implications. So the expected time to trade here is increasing in delta for owners. It's decreasing in delta for non-owners, as I just said. The expected price is increasing in this delta for both these owners and non-owners because both of their own type and who they're most likely to be trading with. That's going to depend on that as well. And so you have like interesting results, like the expected time before the next trade is going to be increasing in the purchase price for current owners and decreasing in the sale price for current non-owners. So one thing that I always thought would be interesting to test, for example, but I never got the data and did it, is, suppose that I had a way of, normalizing house prices in a way to make, to do some sort of hedonic regression where I could get, a rough estimate of whether you over or underpaid for your current house. This model says that people who tended to kind of overpay relative to some fundamental value of the house must have really liked that house. And therefore, it should take them a lot longer to meet somebody who likes it even more. So you could go out and you could test and you could see if people who bought houses at relatively high prices tended to stay in those houses longer than people who bought them at relatively low price. So right off the bat, you have sort of testable implications in asset markets that have very obvious counterparts in labor markets, right? So people have been testing for a long time whether, workers who have high wages tend to stay at those jobs longer than workers who have relatively low wages. There's sort of obvious counterparts to test here with these models. Okay, so here's a couple graphs to just kind of hammer home how these sort of different experiences at the individual level for individual traders manifest themselves in differences in aggregate outcomes. So on the left, the left-hand graph here, which I guess is like a purple and an orange, we plot the arrival rate of trades for owners and non-owners. Okay, so owners in purple, non-owners in orange. And what you see is that the expected time to trade is sort of S-shaped with an inflection point right near that marginal type, that delta star. Okay, so what we see these assets get passed kind of very, very quickly right into a cluster around delta star here. And then the trading speed slows down a lot. The center graph then plots misallocation. So this is the difference in the allocation here relative to the frictionless allocation. And what you see is that there's not a lot of misallocation towards the edges, because if you own the asset and you have a very low delta, you're not supposed to, according to the frictionless allocation, but you trade it really fast. So that doesn't happen very often. Or if you don't own the asset, but you have a very high valuation, in the frictionless world, you're supposed to, but you should buy it pretty quickly. You'll meet somebody who will trade you that asset pretty fast. It's right around this delta star, right in a cluster around the marginal type, that we see the majority of misallocation. And in the paper, we actually prove that this measure of misallocation, as you drive the meeting rate to infinity, that all of the misallocation is concentrated in a small ball around delta star. That this basically becomes a Dirac function at delta star. And the rightmost graph is volume. So where's the sort of all the volume coming from? Well, here there's kind of competing forces, right? If you have a low delta, you trade fast, but there's not that many guys with low delta who actually own the asset to begin with. Or if you have a high delta and you don't own the asset, you would buy one very quickly, but there's just not that many of those guys. So what you see here is a lot of the volume is again being created by this kind of group of investors whose types are near this marginal type defined by the frictionless equilibrium. And that's where all the action is coming from. Now that has an interesting implication for those of you who are interested in sort of network theory and the network structure of markets. What we've done here is we've plotted the I guess sort of a heat map of the density of trades between non-owners of different deltas on the x-axis and owners of different deltas on the y-axis here. Now, of course, remember, because we only trade when non-owners have higher delta than the owners. So it has to be on the right side of the 45-degree line. But what you're seeing here is that a ton of the trade is happening in this dark red section here. And then there's less and less trades going on and these sort of peripheral values of delta. Okay, so there's essentially a core of agents who are doing almost all the trading, and then a periphery of agents who trade once in a while, and they almost always trade in the same direction. So what I'm saying here is that this model, without a lot of features that you would think about, are really important for thinking about a core periphery structure, right? So Bachi Meg has thought about this. Shen Jing and Brianna Chang have a beautiful paper about this as well, about, you know, all sorts of heterogeneity. You might think heterogeneity in inventory capacity, meeting speed, you know, different types of preferences, risk aversion, all sorts of stuff is important for generating a core periphery network structure. One of the nice things in this model is throw all that out. There's still this incredible force towards generating a core periphery trading network just from this basic form of heterogeneity preferences. Okay, so just to summarize what we just saw, and then I'll finish up in about 2 minutes. You know, we said that this very, very simple model generates these chains of inframarginal trades through which assets are reallocated. There's a bunch of papers that show in OTC market that assets tend to be reallocated through chains of inframarginal trades. And I apologize, some of the dates on these papers are from when they're working papers. You know, Alfonso Lagos is in Econometrica in 2015. I think Leon Scherhoff is now in JF. So these need to be updated here. We show that the investors who have the most to gain tend to trade the fastest, but at worse terms, right? Ashcraft and Duffy show this in the Fed funds market using old data, that if you're kind of desperate, you trade fast, but you get a bad price. And that generates price dispersion, right? We have tons of papers that show that in OTC market, there's price dispersion. Alessandro Gavazza has a nice paper in the AER in 2011 where he looks at the market for commercial aircraft, and he documents how much price dispersion. And the last thing is, we say that even without a lot of things that you might think are really important for generating a core periphery trading structure, it comes out naturally in this framework. And there's, you know, oodles and oodles of paper that document core periphery network structures in a variety of different markets, from Fed funds markets to corporate bond markets and so on and so forth. Okay. So in my last 5 minutes, I'll just take some time to tell you about kind of what's going on right now or in the past couple of years using this very basic structure that I just laid out. But before I do that, once again, let me pause again to see if there are any questions.
The result that the volume is largest at delta star,
Yeah.
that doesn't depend on the assumption on PDF over delta?
No.
It's for any, that's interesting. Okay.
Okay, so now is where I'm going to insult a bunch of people by probably leaving out a lot of important work, but I tried on one slide to just think about it, you know, a few papers that have kind of come out recently, you know, been well published and are thinking about, you know, a variety of different either variations or extensions or applications of these types of models to either confront certain things in the data that are hard to explain, or to sort of push the theoretical frontier in a variety of different directions. I'll name a few and leave some time for people to ask more if they find some of this interesting. So Pierre has one of the earliest examples I could think of applying these models to think about a particular phenomenon in the data, where they study what's called the on-the-run, off-the-run phenomenon. So in bond markets, there's this strange feature where you could take a newly issued, say, 10-year treasury, which is called on the run when it's newly issued, and that'll have a certain price. You could take a 5-year-old 15-year treasury. Okay, so there's 10 years left. It's a treasury. It's essentially the exact same asset, but it was issued 5 years ago. That's called off the run. And the prices of these two things are different. So Dimitri and Pierre write down a very nice model where they have sort of parallel search markets with endogenous differences in liquidity and prices to try to understand this on the run, off the run phenomenon. I mentioned before, Alessandro Gavazza has a bunch of papers. He was, you know, one of the first to try and take these Duffy, Garliano, Peterson style models to the data. And several of his papers use data for the market for commercial aircraft, trying to understand different liquidity properties, the welfare cost of frictions, so on and so forth. Garafanzo and Ricardo Lagos have a beautiful paper in Econometrica where they study the Fed funds market. They actually go a step further theoretically as well, because the differences across investors in terms of their desire to trade, also they allow them to have different asset holdings, not just 0-1. They solve that model, they calibrate to the Fed funds market to try and think about the effect of frictions on prices and allocation in the Fed funds market. Julian, Pierre, and I published a paper, I think it's 2020, I should know this, in Restud, where we sort of took the benchmark model that I just showed you and thought of that as the interdealer market in the muni bond market. And so we sort of had a hybrid between last week and this week. We had customers who transitioned back and forth from wanting to buy and sell. And then we had this pure decentralized market where we think of as the interdealer market in the muni bond market. And if you're interested, I could show you exactly how we do that. We calibrate that model to try and understand the relationship between the length of intermediation chains, the changes in bid-ask spreads, dealers' places within the network, the directions that they trade, so on and so forth. Okay, so just to say the bunch of people who are trying to make these models richer and meaningful ways to confront new and better data. People have also explored a lot of different dimensions of heterogeneity. I'll explain sort of a couple here. Is one obvious thing to think about is that different agents might have different meeting rates with other agents in the economy. So in our model, the guys who intermediate the most are sort of moderate valuation because they buy and sell with equal intensity. In some of these papers, the guys who emerge or the dealers who emerge as natural intermediaries are the ones who just meet people the fastest. Maybe they have the best, Rolodex of phone numbers of customers, or they have technology that allows them to trade fast. There are other papers that are just come out. I think one in RFS and one in RED, where you think about heterogeneous capacity. Some dealers are just more capable of holding large inventories than others. Guido Manzio and Mariam Farboudi and Gregor and a co-author have a paper where they think about agents being heterogeneous with respect to their bargaining power. Some people are just tough. They're better at extracting rents from others. That's a different way. And these are all attempts to kind of understand sort of endogenous network structure. There's
Sorry,
a lot
Ben?
of yeah.
This is Santiago from U Chicago. Can I ask you a
Yeah.
point with respect to the first heterogeneity?
Yeah.
Like you can also think like people who trade a lot, they learn more or they become more visible to other people. Is there work on like this learning by doing?
So there's some work on like, I guess sort of, you could think of it as almost like front running trades that if like when you see the order flow, you know more about the aggregate state. Is that the kind of thing you have in mind?
I'm thinking more like if you trade more with people, you're gonna be more I don't know. I mean, if I go to these markets, maybe the chances that I'm gonna meet another person is different than a person that had been in these markets for 10 years. I see.
Yeah, I mean, I'm trying to think. So I should mention, and Bachimeg and others are working on this very actively, that there's something a bit interesting about this whole line of research. So I had two advisors, main advisors. Randy Wright was one of my advisors, and Ken Burdett was another. Randy, worked on money search models where random search with spot trades. So kind of in the spirit of Rubinstein, Walensky, we meet, we trade, we never see each other again. And then, there's this whole other literature of labor search with Ken Burdett, Mortensen, Pissarides, Diamond, all these other guys worked on, which were all about long-term relationships. A worker meets a firm and they're attached to that firm for a long time. This Duffy, Garliano, Peterson literature kind of went down the spot trade route, but it's unclear that in a lot of markets, that's sort of the appropriate set of assumptions, because I think one thing you're talking about is that in a lot of these OTC markets, relationships matter, and people who have been in the market for a long time maybe have more relationships and trade more frequently because of that. And I should just highlight that that's a very active sort of understanding relationships in OTC market. I think there's literally papers called Relationships in OTC Markets, which I think Hendershot and those guys have one. And like I said, I know Batchy-Meg and others are working on this. So there's a couple references. I could probably find more. Pierre, you're listening. You probably have a couple more on the top of your head as well.
There's a paper, one paper that comes to mind is Afonso, Kovner, and Shoar.
Right.
Paper was never published, but for a reason unrelated to the quality of the paper. But you can find it online. It's a great paper, actually. So that it's
and there are empirical papers as well, right?
Yeah.
So DiMaggio.
Oh, that one is
Carvani.
empirical. Sorry.
Yeah, that's what I'm saying. Empirical papers that also study the importance of relationships as well.
Thank you.
And then the last thing I'll mention is that, you know, there's also been this ongoing, at times frustrating attempt to incorporate, you know, private information. And I would say half my kind of research life has been spent at the intersection of information frictions and search frictions, of you know, trying to incorporate, you know, various types of information frictions into models of decentralized trade as well. And you know, a beautiful example of this is by two of the organizers of this, Zach and Bruno, with Nico Tractor. My own student Junwan Zhu has a very nice working paper on this, and so on and so forth. So let me stop there. We have, you know, only 5 minutes left formally, but to see if there's kind of other questions, just in case anybody. I see. Okay, well, we could stop the recording, but I'll hang out for 5 more minutes just in case anyone wants to, you know, off the record, ask any questions or share some thoughts. I'm happy to hang out for a little bit.
I'll stop recording and I have a question.